Oh, yeah.
It's got a little bit of a replay going on there.
Oh, yeah.
So there's a couple people still connecting to audio. So I'm going to mute everyone for now just to make sure we don't have that problem. And we'll see once I stop talking if it echoes.
How is it now?
Much better, much better. I think we're good.
Great, great. So
So
welcome, everyone. We would love it before we get started if you could just enter into the chat where you're tuning in from and how ready are you to purchase a home? Are you looking to do it in the next 2 or 3 months, 3 or 6 months, a year? Let us know what your home ownership goals are.
And you guys let us know too if you're having any problems hearing us or seeing us. There's Tia. Hey, Tia. Okay, 12 to 24 months in Winston. Sounds good. Y'all let us know where you are. And hey, Sherelle, 6 months in Georgia. Awesome. So we're really excited to have you all with us. As we have said a couple of times, we were going to take a super deep dive tonight. So we're going to do our best not to fry y'all's brains, but we are going to make sure that you have as much information as possible so that you're able to get prepared as you get ready for your purchase. So we want to make sure that we arm you with knowledge, not to overwhelm you, but just to make sure that you have your questions answered. So as we go along, we'll both be trying to keep an eye on our chat and everything. So if you do have questions, please feel free, to send them in the chat and we'll be happy to answer those. But I think we're going to cover a lot of good info. So we should take good care of you all tonight. Okay? So as Miss Letitia said, we are super excited to talk with you all. I'm Paris Williford. I'm a realtor and I serve the Winston-Salem, Triad, North Carolina area. And we're going to hop in first to the home buying process. So I am going to show you the kind of the more fun part, we like to say, the glamorous part of looking at homes and getting to hold that closing sign in front of your front door and those types of things. But of course, the lending piece is super important as well. So again, we're going to make sure that you are ultra prepared. And hopefully we are going to do our best to make sure that we can get you all to the closing table in the time frame that you have in mind. So first and foremost, let's talk about why you might be interested in home ownership and why it could be a great move for you. So I think we all are all too aware of how COVID has affected our housing market. And so we are seeing skyrocketing rental rates. I know that I have talked to probably 4 or 5 people in the last couple of weeks who have reached out to me and said, hey, I know you're a realtor, but can you help me find a rental home because even just a basic apartment is teetering on $1,500. And so, our housing market is getting more and more expensive, truly in all the avenues, but especially in renting. And, at the end of the day, when you're renting, you are paying someone else's mortgage plus some. So 9 times out of 10, especially if you're renting a home specifically, it's a little different, of course, in an apartment, you're paying a piece of a huge mortgage. But if you're renting a home, you are paying someone's mortgage, plus enough for them to pay a property manager, plus enough for them to put a little bit to the side for maintenance. And so you really could be in a position to purchase your own home. So just during COVID alone, in the last 2.5 years, we've seen at least a 22% spike in rental rates. And Winston-Salem, specifically the Triad area, the rents are becoming pretty egregious. So we know that that's a huge one. Then secondly, stability for your family, right? So when you're renting, you are at the mercy of your landlord. And so if your landlord decides to sell the home or they want to renovate the home or they're just tired of being a rent landlord and they want to get rid of it altogether, unfortunately, you're at the mercy of the landlord at that point, and you may have very short notice to find new housing. You may have increases in your rental rate, and there's really not anything that you can do about it other than moving. And as we just talked about, rental rates are so high across the board that that could actually cause you to pay more if you had to move. So with, of course, a mortgage and a home that you are considering being in long term, you really have the opportunity to have much more stability, not only for your family in terms of staying in one place, but also for your finances in terms of knowing how much it's going to cost you long term to maintain that home and that payment. So that's a big one as well. Net worth. So this is more of a long-term reason for a case for home ownership. So on average, homeowners have 44 times the net worth of renters. And a lot of the time you are just in a different mindset. And owning a home is usually the first step in beginning to understand how to generate and maintain wealth. And so overall, homeowners have a much higher net worth. They have more assets, more cash, and of course the ability to create more wealth and more income with the assets that they own. And kind of in the same vein, it is a wealth builder. So if you have any interest in generational wealth, Letitia and I are very much into how home ownership leads to generational wealth. And so we believe that becoming a home owner makes you a wealth builder because once you begin working on owning an asset, not only do you have something that you can leave to your family, but in the event that you needed to, have some liquid cash or use equity, then that generational wealth is available to you through the home that you have purchased. So that is a huge one. And that's where we really like to see, our community get a foothold into this wealth building machine. And so I say all of that to say there are many cases for home ownership. There are many reasons why you would want to become a homeowner. But I also want to say, and this is coming even from us as professionals, of course, we want you to buy a home, but also don't rush your own journey. So each one of you is going to have your own personal journey towards home ownership. Everyone has a different financial profile. And so you want to make sure that you're not rushing the journey, that you're enjoying the journey, and that you're going about the process in the right way so that you are making smart decisions. And I think someone got kicked out of the waiting room, so I'm going to let them back in really quickly. There we go. And I'm going to keep on moving. Okay, so we're going to do a high level overview of the process. I am going to try not to rush this, but I will say you might want to grab a notepad and make sure that you jot this down. Now, of course, in working with me as your agent, you'll get, this information and kind of know what's coming ahead as we move through the process. But for the sake of tonight's workshop, you may want to jot these down just so you start to gain an understanding of what the process looks like and kind of what order you do things in. So first and foremost, you want to decide if you're ready to buy a home. So as we just talked about, there are many reasons why, renting may not be a good fit for you anymore, and if it's time for you to buy a home. But you also want to think about, how long would you be in a home if you purchased it? Is it going to be 2 years or less? Is it going to be 7 years or less? You just want to think about your family and kind of what's on the horizon. Of course, you can't predict everything, but you want to think about what's on the horizon for you and your family to make sure that buying a home makes the most sense for you in your current situation. Then you want to calculate how much house you can afford. And that is something that our loan officer extraordinaire is going to talk much, much more about, and also saving for the down payment and closing costs. So we have, always hear about as part of the home buying process, you hear save for a down payment, save for a down payment. And that is a huge chunk of what you'll need to purchase a home. But I always want to be very clear that there are additional costs on top of just your down payment. So although you're able to save for that down payment, you do want to allow for some other closing costs, and we're going to dive much deeper into those and what to expect. But you want to make sure that your savings is in a great position so that you are able to purchase the home successfully. And sorry if y'all hear my 3-year-old. I thought she was going to be quiet for me this evening. Even when the office door closed, she is having a blast. So after you have saved for your down payment and your closing costs, and you feel that you're in a financial position to purchase a home, then you want to go ahead and talk with a loan officer, such as Ms. Letitia Gray, and get pre-approved for your mortgage. So this tells you about how much you can afford, which we kind of have a general calculation from earlier, but you also want to make sure that you have a true lender pre-approval. And so that will tell you not only that someone has looked at your documentation in terms of your finances, but also you don't want to step out to look at homes and make an offer if you're not actually prepared to purchase a home. Okay. And so speaking with a lender or a loan officer and making sure that you're prepared is going to be huge. And then once you're pre-approved, the fun begins. And that's when we go into house hunting. So we're going to go out. I will talk with you about what your needs are and what you're looking for in a home. And then we will set up a search based on the criteria that you're looking for. And you will be able to go out, take a look at homes. And our goal is to look at as few homes as possible because we should have a very good idea of what you're looking for. And so we want to go out, take a look, put our eyes and our hands and our ears in a home to make sure that it meets our needs. And so you'll want to begin thinking about things like how many bedrooms and bathrooms, what type of neighborhood do you want to be in, what school system do you need to be in, those types of things, or school district rather. So you want to make sure that you have a good idea when you head out house hunting. Want to make sure that we've really got it narrowed down so that you're able to get out there, find exactly what you're looking for, and be prepared to make an offer on the home. You've probably heard that things are moving very quickly, and we're going to talk much more about the market. But when you go out house hunting, you want to go with the intention of being ready to make an offer once you find a home that meets your needs. And so we've been house hunting, we have fallen in love with the home, and I do always tell my clients, you want to choose a home that checks your boxes. In this current market, you don't want to fall so in love with it that you're going to be devastated if your offer isn't accepted because it is very competitive. But if it's checking your boxes and you're all giddy on the inside, then it's definitely one that you want to make an offer on. And so if that offer is accepted, then the work begins. So the fun part is really the house hunting, making an offer, having those butterflies. But if your offer is accepted, then the work begins. And we go into what's called a due diligence period. And the due diligence period is your time to do all of your investigations and your inspections on the property. So this is when you would take care of your home inspection, which tells you about the structure, the systems, the safety of your home, what you can expect in terms of maintenance when you own this home, because you do want to keep in mind that you do not have a maintenance guy, right? When you are a homeowner, you will have to make those repairs and pay for those repairs on your own. And so your home inspection really tells you about the condition of your house and what to expect. Now, the basic home inspection is really your interior, exterior. If you have an attic, crawl space, or basement, it will cover those items. But if you need things, and usually you want to do your first home inspection just to see what kind of condition your property is in, but you may also need some additional inspections. So things like electrical or your HVAC system or your roofing, if your basement needs to be waterproof, those types of things. That's what you'll want to do during your due diligence period, is have all of those items inspected. And the biggest piece to remember about this is that all of those inspections have a cost. So again, in addition to being financially prepared and approved by a lender to buy a home, you will need some costs up front in order to purchase the home. The appraisal is ordered by the lender, and this tells the lender the market value of your home. So this is also something that you pay for upfront, and it allows the lender to know that if they are giving you a mortgage on this property, that it's actually worth what you offered on it. And so, you've probably heard about appraisals, and that is a big hurdle to get over. Now, of course, if you have a fabulous agent, then we will look at competitive properties that are nearby that have sold recently to make sure that we're offering a fair amount for the property. But it is something that we have to be aware of because the bank is only going to lend on what your home appraised for. So that's very important. And I'm going to slow down for just a hot second to make sure that I haven't missed any questions. I see one. If you are renting and have a lease, how soon should you be looking for a home? I understand it can go quickly or slow. And so this actually depends on your financial profile. And so if you are in a financial position to purchase a home right now and your lease has ended, like you're on month to month or something like that, then you want to be you're probably within a 3 month window. If you are not within that window, because you basically you want to have a 30 to 45-day process to look for the home, be prepared to offer on a home and go under contract. And then you want to have about a 30-day window for closing on the home. Absolutely. So if you are financially prepared and not in a lease agreement, that you're basically ready to move, then you want about a 3 month lead time on talking with a realtor, talking with a lender, and getting out there to make offers and purchase. So again, it depends on your financial profile. So if you are not in a position to purchase right this second, it depends on how long it's going to take you to remedy whatever those situations are, whether it's credit, debt, income, whatever the situation may be. That's how you'll gauge how long it will take you. So for example, if you have a situation where you need more savings, then you would want to calculate about how long it's going to take you to save, then add the 3 months on top of that. So I hope that makes sense. And please let me know if it doesn't or if anything is unclear. So I'm gonna dive back in to the due diligence period. So after you have gotten an appraisal, you'll also want to negotiate any repairs. Now, North Carolina, if you're in North Carolina, is an as-is state, meaning that when you go and make an offer on a home, you are taking it in that condition. It's going to be an as-is condition. And so the seller does not have to make any repairs just because the home is under contract. It can be sold with defects. It can be sold with repairs needed. It can be sold falling apart. But so every home is sold as is. However, it is, favorable for the seller to be willing to make some repairs. And so you can request repairs in our current market, which again, we're going to talk much more about. In our current market, it's a little bit more difficult to get, a laundry list of repairs. You want to be very pointed and calculated with your repair request. But that would be the time during your due diligence period to request those and to understand if the seller is going to make those repairs. And if not, do you need to request a reduction in the price, or are you going to be prepared to take on those costs once you purchase the home? And then the last thing I have here is the homeowner's insurance. And so that is a cost that is associated not only at closing, but throughout the year. And so Miss Letitia is going to go in much more detail about that as well. But once we really get through that due diligence period, that is the largest hurdle of the purchasing process. And that's when you're really sure that you're not only financially able to purchase, but that you can kind of live with what you put an offer on. And so sometimes when I explain this to people, they say it seems a little bit backwards. Like you should be able to do all of this investigation before you put an offer on a home. But unfortunately, that is not the case. So you actually have to make an offer just on what you've seen visually and what you like about the home, and then you have the opportunity to inspect it. In fact, number 7 there, right between number 6 and 7 there, the due diligence period, there is actually a fee that is associated with putting the property under contract. So not only do you not get to do all of these inspections before putting it under contract, but you also have to pay a fee. You don't have to, but it is customary to pay a fee to say, hey, Mr. Seller, I appreciate you taking your home off the market for me for the 30 to 45 days that it may take me to close. So here is a lump sum of money in order to take your home off the market. It used to be that this was about the amount for the seller to cover their mortgage just for the time that it's sitting there while you're doing your investigation. With our market being as fast moving and competitive as it is now, that's really gone out the window. And I'll talk more about that with the market as well. But you can expect to have anywhere between $3,000 and I have a buyer who just spent $10,000 in due diligence fees in order to put the property under contract. And there are two types of fees associated with going under contract. Again, don't want to fry y'all's brains, but there are some fees associated up front with going under contract. So the biggest piece to remember there is you have some major costs that are associated with purchasing the home before you make it to the closing table. So it is not just your down payment. There are many other things that have to fall into place prior to closing, prior to you even paying a down payment. And so you want to be prepared for those. And as long as we get through, and again, you have a guide to help you. So once we get through that due diligence period, that is when you're ready to close on your home. So I'm going to slow down for a second and see if you all have any questions about this process. I tried to take it as slow as my little brain will go, but I know that I tend to rush through it. So please let me know if you have questions about, a specific step or a specific term there that doesn't make a ton of sense to you. This is an open forum, so feel free to unmute your mic. Feel free to just let us know what your questions are. So if you guys are feeling good about the process, I'll keep going, but I definitely want to give you the opportunity to ask questions. Okay, I'm going to keep going. Y'all are very quiet. Okay, now I've gone through all of that and I've said several times based on our current market. And that is something that you will hear me say a lot. Because the key to me being your advocate, oh, here's a question. What is the typical range for down payment and closing costs? Miss Letitia has got you there. So I'm gonna let her take care of that because she's gonna do a deep dive for you. So thank you for asking. We're gonna make sure that we cover that in detail for you. So hold on to that one for me. But we'll get there for sure. So the current market, so as your realtor, it's my job to advocate for you, but also to make sure that you are prepared for what you are stepping into. So yes, you can be completely financially prepared. You can be pre-approved for a mortgage loan. You can be ready to walk out into the world and buy your home. However, you are also going to be competing for the same home against other people who are just as prepared, if not more financially prepared as you. So let's talk about what that means. So you hear us say the market. That's something that is kind of like a general term in our industry. And so what does that really mean? It's basically the conditions or the factors that are going to influence your purchasing ability and your experience. So it is going to dictate the market, meaning how things are going out there in the home buying world, is going to influence how easy or difficult it is for you to purchase, what your experience is like purchasing, and kind of what your expectations should be. So let's talk about our current market. So you've likely heard that we're in a seller's market, and we are. We are in the seller's market of the century. So this means that the sellers have an advantage because there are more people looking to buy their homes, the same types of homes in the same price range at the same time. There are so many of us out there looking at the same homes that there is almost always a multiple offer situation, meaning that there's more than just you who is offering on the home. And the stickiest part of all of that is that you don't get to know what's in the other offers. All that you can do is come with your best offer, what you can afford to do and what you feel comfortable doing. And from there, the sellers take a look at all of those offers and make a decision about which one is most appealing to them, which one they think is most likely to be complete, meaning make it to closing, and which one is going to be the most financially profitable for them, usually. And so it is a tough time. I think Letitia and I are very transparent, and we're not necessarily going to sugarcoat. We're going to be honest with you. So it is a difficult time to be a buyer if you are not working with a whole lot of cash. But if you have the right team, it is possible. So I want to give you guys an example of a buyer that I'm working with right now, and I'm super proud of him. He went under contract on Monday. And so I just want to give you this kind of an overview of kind of what he's working with. and that will kind of help you understand how this works. So he is a young single individual who is looking to purchase a home. So he's working with one very thank you, congratulations. So he is working with one very typical income. All right. Actually, because I know T is in here, I'm gonna go ahead and say he's working with a teacher's income. Okay. So this is very possible. Okay. So he's working with a teacher's income. We knew going into the market that we were going to have patience. And that's something that we talked about very, very often. In fact, we knew we were going to have patience. We knew that we were going to be resilient and that we weren't going to give up because he was using an FHA loan, which Ms. Letitia's going to talk about more. He was using a down payment assistance program and did not have a lot of cash to work with. And so, we had concerns about his ability to compete because the price range he was in is also one that investors deal in. So there were folks who he would go out and he's giving it his all. Like this is the amount of cash I can put up. This is the fastest I can close. This is the most I can offer you based on my pre-approval letter. And he would literally lose to someone who could offer, I will pay you in cash. I will close in 12 days. I won't do an inspection. I don't need an appraisal, nothing. And so that is the type of market that we are dealing with. So again, it's not impossible, but you have to be prepared to be patient. You have to be prepared to be resilient and to continue to try, even though it seems discouraging. Because we looked at some homes that I think the first time we looked at a home that he fell in love with, and he didn't win the offer, it was like a reality check. And then he was like, okay, this is business. We just got to keep at it. And so again, it doesn't mean that you give up what you want in terms of the home that you're looking for, but it's just something to be aware of. And so again, we do not want to scare you. We don't want to keep you from working towards purchasing a home. We just want to be very transparent and make you aware of what you'll need. And so again, we're going to get into the numbers, but we just want to make sure that you understand it is a seller's market. You are going to have to be prepared to compete. And so the key to that is making sure you're in the strongest financial situation that you possibly can be in. So again, it is absolutely possible. It just might take a little bit of patience. So I'm gonna slow down just a little bit. Well, actually my next slide is about the market as well. So I'm gonna keep going, but if you have questions, feel free to unmute or put it in the chat. So again, the current market is pretty much for buyers right now. Shut up and take my money. I love memes. So here's a meme for y'all. So this is basically what happens when a home goes on the market. In hours, there are people emailing, calling the listing agent. What does your seller want? How much will they take? And I mean, throwing their money at it. And so these are some statistics from over the last year, just to give you an idea of what we're dealing with. So the average list to sales price. That means if you see a home that goes on the market, it comes on Zillow, right? And it's a $200,000 home. In the last year, on average, it has always sold for more than $200,000. And that could be anywhere from 1% over to 10% over. It depends a lot on the price range that you're in, but really, truly, almost every single home that is going on the market right now is selling for over the list price. So we call that over 100% of the average list to sales price. So for example, with my same buyer, and again, I run all these comps before we will write an offer. In every neighborhood he was looking in, the average list to sales price was about 105 to 107% of the list price, excuse me. So you want to be prepared if you are able to go 5 to 7% over the list price in order to be competitive, because you'll have folks who, if it's a $200,000 house, they'll bid 225, 250 just because they want it that bad, or they're that tired of looking, or they have cash, or whatever the case may be. And so you want to be prepared to see things go over the list price. You want to get comfortable with going over the list price if it is your dream, if it's checking all your boxes. Now, that doesn't mean you go over your pre-approval amount. So with working with me, you will always look at homes that are under your pre-approval amount so that you are able to go over the list price if necessary. So that's an important piece. So almost every home is selling for more than it's listed for. That's a major key. Desirable homes are only on the market for 3 to 4 days max. Y'all, when I'm being dead serious, they put these homes on the market on Thursday, and by Sunday evening, if that, they are under contract. So I have done a lot of going out to make videos for clients if they can't get out to see a home immediately. I have written sight unseen offers where my client is solely going off of the photos. That is not something I suggest or prefer, but in the market, if you feel comfortable doing that, that is something that other folks are doing. So it's just something to be aware of. So desirable homes are only staying on the market for 3 to 4 days right now. On average across the board, it evens out to about 13 days, but that is with, lots of little variances in there. So let's say we've got some investment homes that are not in great shape. They may stay on the market 10 or more days, or you've got homes that are quirky or need repairs. They may stay on the market a little longer. And so they skew that average, but really homes that you look at on Zillow that you're like, oh, this is beautiful, I can afford this. I guarantee you there are at least 10 other people minimum who are looking at that home who can't afford it, who are in love with it as well. So that's just something to be aware of. The average sales price is increasing about 12 to 15% per quarter. And what that means is that when a home sells, so for example, I could have sold a home in a neighborhood last year, and this year that the same type of home, the same age, the same size, in the same neighborhood might cost 12% more, just because people continually push up, right? So every time that a home goes on the market and someone offers over what it's worth and over what it's worth and over what it's worth, it pushes it up. And so that pushes the neighborhood up. And pretty soon, things rise. And so the whole neighborhood could increase, 12 to 15%, just based on, what people are willing to pay for the property. So that's something to be aware of. You could look at something. This actually happened to me looking in a development, and the homes during COVID skyrocketed by about $50,000 from year to year. So you want to be prepared to see some jumps, especially just in economic times that are a bit more unsure. We're seeing some really, really big jumps in the average sales price. And then lastly, the due diligence fees. So the due diligence fees are ranging, and this is an average for me, for my buyers that I am actively out working with who are winning offers. I do not encourage you to step out of the house without $3,000 liquid cash that you can put up to go under contract on a home. That is just like, honestly, the bare minimum that you want to step out with, and that is to put a property under contract. So that is outside of your down payment, that's outside of your inspections, your appraisals, and any other costs that are associated with purchasing a home. You just want to have some cash cushion that's going to go towards putting the property under contract. The wonderful thing about the due diligence fees, and the reason that I didn't harp on them for too long, is I don't want to scare you, because as long as you are able to close on the property, those will be credited back to you at closing. The due diligence fees and earnest money, which we didn't touch because we honestly are not touching it much in this current market. If it's something you're interested in, we'll talk in much more detail about it, but really it's not winning offers. So I didn't want to add some unnecessary information for y'all. So due diligence fees are ranging from about $3,000 to, if you're serious, $10,000. Now another story, and I hope I have time for all my stories to teach. I'm not just all over the place. So another story that I want to tell y'all, and I have not told this story yet because it just kind of got ironed out. I had some buyers who they were purchasing the property in cash, and they really fell in love with this home, and they were so serious about this home that they put $10,000 in due diligence. They put $10,000 in cash up front to say, I'm serious about buying you this house. I'm serious about buying this house. I'm going to give you this $10,000 to put it under contract, If I don't buy the house, you get to keep it. If I do buy the house, it goes towards my closing, right? So that's what they did, 10K in due diligence. We got to the home inspection, and this is so strange, y'all. The seller's twin brother pulled up like crazy in the yard and was like, don't buy this house. It's been on fire. It's got a bad septic tank. Like he just started, saying like this house is not in good shape. They're trying to get rid of it. Now, why he hated his twin brother, who knows? But either way, he pulled up on them in the yard and was like, you don't buy this house. Well, thank goodness that's why you have a home inspection, because there are things that you may not see. Come to find out, there was evidence in the kitchen because they had a beautiful brand new kitchen, right? Well, guess why it had a brand new kitchen? Because the last kitchen had been on fire twice. So it had electrical issues, it had septic issues, which are things that you cannot see from viewing the home. It's things that you learn in an inspection. Crazy. It's things that you learn in an inspection. And that is why I do not let any of my buyers buy a home without a home inspection. So yes, oh my goodness, right? So my client, because they had already paid their $10,000, we tried to scare the seller and his agent with legal jargon. You have to give this back to us. It's a breach of the contract, blah, blah, blah. So they decided they were going to fight it. So the seller claimed, I bought a car, I did all this other stuff. I don't have y'all $10,000 to give back. Sorry, pay it for you. So we're like, no. So, we had to go the legal route. And I am so happy to say that about a week and a half ago, my buyers won their court case against that seller and are able to get their money back. But this was probably 4 months ago. And luckily they were cash buyers. So they had it, like they could lose that money and still buy a house. So they ended up closing on a different house. A month later, we kept on moving while they were dealing with this court situation. But I say that to you all to say, if you are not a cash buyer and you are dealing with your own money that you have worked so hard for, you can't afford to lose it, right? And so we have to make smart decisions with the homes that we put in offers on. We must get a home inspection. These are costs that you cannot skip. You cannot skip the home inspection. You cannot skip the appraisal, because we want to make sure the home is worth what you're going to pay for it. All of these things, although they cost you money up front, they are actually to protect you. And so these are costs that are like, they hurt your pockets up front. That due diligence fee hurts up front, but you get it back as long as you close. And again, all of those costs are to protect you. So I tell y'all that not to scare you, because at the end of the day, I'm going to advocate for you. I'm going to fight like I'm buying the house. Okay. And actually my brokerage and our brokerage attorney, we're all going to fight for you like we're buying the house. And we're going to make sure our clients are taken care of. But I say that to let you all know that although the market is crazy competitive, we're not going to get crazy. We're not going to waive inspections. We're going to make sure that we are still not rushing the process, right? We're still going to make sure that we are going the right way about purchasing a home so that you are pleased with your purchase for years to come, not so that you find out something later. So I say all of that to say it's moving quickly, but that doesn't mean we take shortcuts, okay? So I appreciate y'all are all like, oh my God, that's crazy. So I appreciate y'all for sticking with me through my crazy story. But I had to tell somebody that. Clearly had to get that off my chest. So let me know if y'all have questions about the market. I'm going to slow down for just a minute and see if anyone has questions about what's going on in the market and what to expect. So far, so good. Okay, I'm going to keep going. Okay, so we just talked about this. Most of us, because those clients that I just told y'all about were cash buyers, right? But most of us don't have enough cash to just purchase a home at full price. We're going to need a mortgage loan, right? With a mortgage, you agree that your home is the collateral and you're going to pay down the total cost of that house over a term. It could be 15 or 30 years. Those are the two most common that you hear about, a 15-year mortgage or a 30-year. And so the first step, as we talked about in our process there, once you decide that you're ready to buy a home, you want to get pre-approved by a lender or a loan officer. And so I'm about ready to stop talking y'all to death, and I'm going to turn it over to Miss Letitia. So I'll say this. As a realtor, I recommend speaking to a loan officer like Miss Letitia or a lender to who is going to give you the real truth. Okay. So this is my soapbox about credit repair specialists. So it's not shade to credit repair specialists, but in all honesty, a lender has so much more depth in what they can see about your financial profile. Like seriously, do not try to play them by getting stuff deleted or getting stuff, I don't know, disputed because it's going to come back on, or they can see what you did. Like leave if you can. If you're in a really bad spot, that could be a different situation. But truly, if at all possible, leave your credit repair specialist where they are and talk to a loan officer so that they can help you determine realistically how prepared you are to buy. So they're going to really be able to look at your financial profile and tell you how to improve it, whether that is through income, debt, credit score, savings, whatever the case may be. They're going to be able to give you a much, much better idea. And so I know that Ms. Letitia takes wonderful care of her clients. We just did a podcast that came out yesterday, and we both talked about how much anxiety we have around making sure that our clients are taken care of. So she's going to take excellent care of you in making sure that you are truly financially prepared to purchase the home so that things go smoothly once you're under contract. Because what we absolutely don't want is for you to lose any money or just to be discouraged by the process. And my voice is going on me. So very quickly before I turn it over to her, the basics. You're going to need to have stable employment. That's about a 2-year minimum. And I'll let her talk more about all of these. A minimum 620 credit score. And I recommend to my clients, you may get different numbers from different people, but for me and my experience and what I know works, you want to have a minimum 7% of that purchase price saved. And she's going to talk more about how that breaks down. But if you are going to have a purchase price in mind, you want to have 7% of that put aside, to prepare for your transaction. And then we really want to make sure that you are financially stable. So you cannot have NSF, meaning going in the red and having those NSF fees. And you cannot have undocumented financial activity. And that means, I hate to say, no cash. So you cannot have large or regular cash deposits. It has to be your payroll, your direct deposit. And even if you are an independent contractor, you really want to make sure that you're documenting things properly. So I'm going to, of course, pass it over to the expert to go into much more detail. But again, I'm Paris Williford. I'm turning off my camera, drink my tea, but I'm here. I'm going to keep an eye on the questions and help Ms. Letitia as much as I can. So I want to say before I turn it over that it is normal. It's totally normal to already feel overwhelmed by this information. And you may feel a bit more overwhelmed once we get to the numbers because I don't math, so that overwhelms me. But don't be. You have the right team. You're going to be able to do this. We're going to be able to assist you. We're going to walk you through it. We never, or I say I never, I'll speak for myself. I never say it's a stress-free transaction, but as low stress as possible. Because it is a roller coaster ride, but we got your back. So we are here for you. Again, I'm still here. I'm just drinking my tea, and I'm going to pass it over. And y'all, if you have any questions, feel free to chat me.
It's just looking for my mute button to mute myself. Okay, hold on one second. Let me get everything situated. Paris, that was great. The information that's just absolutely golden. And I'm excited to share with you all just some more information to help allow you to be empowered with what is going to happen on the lending end and that lending process. I know that a lot of times that's the area where we feel a little bit more intimidated or just unsure because there are a lot of things that happen. This is a major purchase that you are making. And so I'm here to help educate and to empower you so that you can make this purchase. So I just want to make sure that you're seeing my screen that says home ownership is possible. If you can let me know, let me see if I can pull up the chat. Are you guys, or you can unmute yourself if you're able to see if we are seeing the right screen.
You see it?
Okay, great. Okay. So home ownership is possible, just like Paris was sharing. There's so many things that you can gain from ownership. You can gain community, ownership, power, the ability to control the space that you live in. And my favorite, Paris's favorite, is wealth building, the wealth building opportunity. So before we get started, I'm just going to share a quick video that is kind of reminiscent of this environment that we are currently in. Oh, wait.
Excuse me. Is that
Hold
apple
on
for
one
sale?
second,
Yeah, we're
guys.
about to put it on sale right now. Excuse me. Is that apple for sale? Yeah, we're about to put it on sale right now, actually. Well, I'm in the market, so tell me about your apple. Why should I buy it? Nice try. Okay, people, here's how this is going to work. I have an apple here. The highest bidder's going home with this. I want all bids in the next 2 minutes, then we're closing it. Bidding starts at $5. Feeling pretty confident there, huh? I mean, don't you? $10. He said starting at 5. 15. Is this a new apple? Yeah, just listed. I'm pre-qualified. I'll pay cash. I got cash. 20. 30. No, just make it 45. Is it even worth that? 50. I don't know. Please, this is the 8th apple I've tried to buy. Can I at least see it up close? Nope, it's an apple. You know what it is. You either want it or you don't. I'll take it for 100. What? I'm from California. It's the cheapest apple I've ever seen. 120. Why did I do that? Why? I don't. I want to be there, baby.
So I hope you guys were able to see that video. Is that kind of reminiscent to where we are right now, Paris, as far as the environment that we're in?
It is the most accurate representation of where we are right now. It's so perfect.
So we just wanted to share that because I relocated from New Jersey to North Carolina. And so, I understand how challenging it can be, but it is so possible to own a home. And I just want to confirm, you guys are seeing my What You Will Learn Today screen. I'm flipping between the video and the PowerPoint. So I just want to make sure that you're seeing what I'm planning for you to see right now.
Yes.
Do you guys see what? Okay, great. So thank you, Tia. So we're going to hop into what we're going to learn in this portion of today's workshop. So we're going to talk about the 10 commandments of home buying. We're also going to talk about the requirements for applying for a loan, down payment and closing costs, and then some other options that you may want to consider. We're also going to talk about traditional loan programs. We're going to talk about my role as a loan officer. And then we're going to talk a little bit about the power of equity. Before we get started, I love quotes. I just love quotes. They're inspiring and often truthful. And so this one is by Oprah Winfrey, and it says, "I will forever believe that buying a home is a great investment." Why? Because you can't live in a stock certificate. You can't live in a mutual fund, but you can live in a home. And so I love that because it is true, not to say that stocks or mutual funds are not good investments, but homes just add something different. It's property, tangible property that you can hold on to and live in. Okay, so let me tell you a little bit about myself. My name is Letitia Gray. I am a loan officer with Crown Home Mortgage. I'm a licensed residential loan officer in North Carolina. We also do commercial lending as well. I have a bachelor's in business administration and a master's in organizational leadership. I've worked in the budget finance industry for over 11 years prior to starting in the lending industry. I'm a wife, I'm a mother of 5, y'all. I'm a mother of 5. And I'm also a homeowner. So I have been through this process. I've been through homeowner workshops. I've been through fixing my credit. I have been through all of the things, saving, using my refund check to purchase my first home. I've been through all of those things. And so I absolutely love to share the knowledge that I have with other people to empower them to do the same, to be able to purchase. I'm also a podcaster, as Paris mentioned. We just released an episode episode 175 of Boss Ladies Connect, where we were just having a really great conversation around the market, around her role as a realtor, what it's like to be a realtor, and what it's like to be a buyer in this market. So feel free to check that out as well. And I am extremely passionate about helping people build generational wealth through home ownership. It is such a powerful tool if used correctly. And so I am so invested in doing that. And that's a part of the reason why I do what I do. So one more thing about me. I'm a homeowner, as I shared. This is a picture of me and my husband. When we purchased our home, we moved in the middle of the pandemic. We moved in 2020 to North Carolina. And I just want to encourage you guys today that this could absolutely be you. This could absolutely be you. This will be you, especially after this workshop and you have the information you need to prepare yourself for home ownership. So are you ready? Let me see in the chat. Are you guys ready for home ownership? Okay, let's dive in. So we're going to be talking about the 10 commandments of home buying. The 10 commandments, just like the commandments in the Bible, are things that we should live by because it will benefit us, right? And so the same thing with the 10 commandments of home buying. These are things that you want to live by when you are preparing to apply for a mortgage and also preparing to purchase a home. This will make the transaction much smoother, and this will help you get to your end goal, right? So the first one is thou shalt not change jobs, become self-employed, or quit your job. This is super, super important. What we will require as a lending company is 2 years of employment, and it has to be 2 years of continuous employment. So the reason why not changing your job is so important is because if you change your industry, then you're now starting that 2-year cycle all over again. When you're thinking about being lent money to purchase a home, the risk factor is what the lender is going to be looking at. You know, how great of a risk are we taking with this individual? So 2 years employment assures us that there is a consistent income that is going to be able to come in. So let's just say you were a nurse and then you switched industries, and then maybe now you're in tech, right? Maybe you were a nurse for 10 years, but now you're in tech and you've only been in tech for 5 months. Then that's not considered 2 years of continuous employment, because now we want to make sure that in this tech industry, or if you've started a new company, that this company is actually going to be able to provide you with 2 years continuous income, right? And so, well, more than 2 years continuous income, but we want to, the way that we are able to prove it is to see that you've been able to make money in this particular industry for 2 years. And so that's super important. So no quitting, no changing jobs, no changing industry. Well, no changing industries. You can change jobs if you're doing like a promotion within the same industry that you're in. That's fine. We want people to make more money. You want to make more money. And so we understand that. But just any major changes in your employment, you want to be mindful of. Number 2, thou shalt not buy a vehicle, or you may be living in it. As we continue in this conversation, I'm going to talk more about debt to income. And so one of the things that we are going to be looking at is what your current debt is. And if you purchase a car in the middle of this transaction, that is increasing your debt. And typically car payments are anywhere from $200 to $500 to $600 a month. And that's a big hit to your debt. So you don't want to make any major purchases during the time that you are applying for a loan. Okay, number 3, thou shalt not be late on any payments. This is a time when you want to show again your ability to pay back your debts, right? Think of it as if you were lending someone hundreds of thousands of dollars, right, you would want to ensure that they are able to pay that back and that they pay other people back on time. And so it's the same thing, it's the same concept. And so you want to make sure that you're making all your payments on time. Number 4, thou shalt not reduce account balances below what you told or provided to your loan officer. So another document that we're going to be looking at is your bank statements, because as Paris was talking about, you're going to need funds for the down payment and the closing costs. And so we are going to want to confirm that you have those funds, or you have close to those funds, or you will have those funds by the time that we are looking to close. And so if you change your account balance from the time that we initially got it, then that can present a problem when it comes time to close and you having the necessary funds. And so these are things that you want to be mindful of, you want to be thinking of as you're preparing yourself for home ownership. I can't see the chat, so please feel free, Paris, to let me know if someone has a question in the chat.
I got you. There's
Okay.
there yet.
Okay, great. Thank you. Number 5, thou shalt not forget to include all debts on the application. So it's super important that you share with us all of the debts that you know that you have. Paris, did you have a question?
Yes, we have a question. Can you keep the funds in a savings?
Oh, yes, most definitely. I'm going to talk well, I can talk about that more now. So we're going to look to see that we're going to ask for 2 months bank statements. So for us, money needs to be seasoned, and that means that it needs to sit in the bank account for 2 months in order for it to be seasoned. And I'll talk a little bit more about that. I know Paris mentioned cash. I'm going to talk a little bit more about that in a later slide. But yes, the answer is yes. Okay, so yes, you want to include all of your debts, right? You want to make sure that you're letting us know, because we're going to pull the credit report, and we're also going to run checks to make sure that there are no judgments or liens or anything like that on you. So it's always best to let us know upfront so that we can advise you as to the best next steps, so that whether it means that, okay, you have to rectify this first, or maybe you'll just need to supply X, Y, and Z, it's always better to know upfront, because you don't want to have gotten yourself into an offer situation and you're putting up this due diligence, and then there is a debt that wasn't disclosed in the beginning, and then now that debt becomes revealed, and then it could possibly damage your possibilities for getting the loan, which would then in turn cause you to lose your due diligence. So all these things are super important. You want to make sure that you're just sharing this information with us. Number 6, thou shalt not buy big ticket items. And so I know we talked about the car, but when I say big ticket items, I'm talking about things like furniture. Like typically you're buying a house, and so you're excited and you're in the preparation to move into the house, and it's like, oh, I want some furniture. I want to furnish my house. I want it to be ready when I move in. Well, furniture is very expensive, and that is going to be another debt that we are then going to need to add to this debt to income ratio. So the focus at this time should really be on saving as opposed to spending. So number 7, thou shalt not apply for credit anywhere until your loan is complete and closed. This means credit inquiries too. So this is really important too. The same thing, let's say if you wanted to get furniture, you don't want to open up a credit account to get this furniture. That again is new debt. You also, as far as credit inquiries, please, your credit is run in the beginning of the process so that we can discover what your credit scores are, but your credit is run again prior to closing. So if it wasn't on the credit report when we first started this process, we're going to run the credit again. And if it's there, you're going to need to give an explanation. You may possibly need to pay pay off something if it changes your debt to income ratio. So it's just super important. You don't want to do any of those type of activities while you're in this process. You want to wait to do those type of things after your loan is complete and we've closed. So number 8, thou shalt not make unusually large deposits into your account without first consulting your loan officer. So what that means is when I say unusually large, that is an amount that is larger than the typical deposits that you are making into your bank account, right? That will raise a flag. We'll have to ask questions about where those funds have come from. So let's just say, like, I don't know about you guys, but my mom, she keeps money in all kinds of places, in her shoebox, in her pillowcase. She keeps money in a lot of different places. Let's just say you do that as well, and then you want to take all of that money and you want to put it into the account. Well, that presents a problem because we can't source it. We can't prove that the money was in your pillowcase or that it was underneath your bed. We don't know where the money came from. And then that goes back to the seasoned money and needing to be in the account for at least 2 months. So if you do have money, big lump sums of money that you have somewhere, you want to put that in now before you start the process, so that money is actually able to be seasoned and have sat in that account for 2 months or more. Okay. All right, number 9, thou shalt not close, open, change bank accounts. It's all in the same frame of thinking. If you close a bank account and you open a new bank account, then that money in that new bank account has not sat there. It has not sat there, has not been seasoned. And so you just want to be mindful. You don't want to be making any major changes during this process. The process also, I should say, takes about 30 to 45 days. If you're doing like a renovation loan or a longer project, it could take up to 60 days. So you want to keep that in mind as you're preparing for home ownership. And number 10, thou shalt not co-sign on a loan for friends or family. It is the same thing. That debt is going to be considered your debt as well. And then it's going to be calculated into your debt to income ratio, which we are going to be talking about in a few slides. And so I think I see something in the chat. Let me see. Oh, okay, I answered that question. Great. If there are any other questions, please let me know. And I'll just keep moving on. So when should you get pre-approved? Paris did a great job of talking about that. That's one of the first things that you want to do because you want to know how much you qualify for. I did want to talk a little bit about the difference between a pre-approval and a pre-qualification. So a pre-qualification is similar to when you get credit cards in the mail, like you get those envelopes and says you've been pre-qualified, or you can get $2,000 and no one has checked any of your information. They've just done maybe a soft credit run. They haven't verified that you're working. They haven't verified anything. And they're telling you that you've been pre-approved for you pre-qualify for something. So pre-qualification is the same thing. It's just a verbal exchange of information. Is you telling me how much you make? Is you telling me what you think your credit is? Is you telling me how much you would like to purchase for? And me just running numbers based off of the conversation that we had. Pre-approval is different. Pre-approval is where you have I have verified the information. So I've asked you for that supporting documentation to verify the information you have given me. And now I can see that, yes, they do make this much money. Yes, this is their credit. Yes, this is the debt and things that we're going to be considering. And we can hash out or work out all those things in advance so that you can be pre-approved for this mortgage. And sellers like buyers who are pre-approved, because it means that the work has already been done. Verification has already been done. And that allows you to shop in confidence. It's also going to let you know how much you're actually approved for, how much that's going to cost you. And so you're able to go out with more empowered, knowing what you can afford and what your budget is. So pre-approval is always what you're looking for when you're shopping around for a mortgage. Any questions before I move on to the next slide? I know it's a lot of information. Let me know if you have any questions. Okay, so now let's talk about some of the required documentation. I mentioned some, but I'll just go over some more so that you, again, can be prepared for the documents that we will be asking for, which will make the process go a lot smoother. So the required documentation is 2 years of personal tax returns. So that means the most recent 2 years that you just filed. If you are a business owner, you'll also need to include 2 years of your business tax returns. A quick note.
Did it freeze for anybody else?
Dollar amount now. So when we're looking at your tax return, even though you may have made, can you guys hear me? My internet connection is a little bit shaky.
We can hear you now. It went out for a few minutes, but we can hear, or not for a few minutes, just a second. We can hear you now.
Okay, great. So if you are a self-employed borrower and you are showing us your tax returns and you have your taxable, let's say you brung in $100,000, but after all of your deductions, your taxable income is $50,000. The dollar amount that we're going to use to qualify you is the $50,000. And that's for business owners or self-employed borrowers. So you want to be mindful of that. There are other non-traditional programs that if you're interested in learning about, we can have a conversation, you know, an offline conversation about it, like bank statement loans that will allow you to use your bank statements as opposed to your tax returns for those type of transactions. But I just want to let you know that that is the number that we'll be looking at. We're also going to need 2 years of your W-2s or your 1099s. We'll also need 2 months of your most recent bank statements, which we talked about. If you are going to be using alimony or child support as income to qualify you, we'll need proof of that as well. I did want to let you know that you're not required to use that. So you can be receiving that and not disclose that information. That is completely up to you. If you have earned a fixed income, say you're retired and you're getting a pension or you're getting Social Security, that income can be used as well. And we'll just need the award letters to prove, to verify that information. And then lastly, if you're going to be using any type of stocks or 401ks, we'll need verification of that as well. So this is just the basic documentation that'll be needed at the start of the application. We'll talk a little bit more about the process that the loan goes through as it goes through underwriting, and that there may be a little bit more documentation that's required at that point. But this is the information you want to have on hand. You want to have ready when you're applying for a mortgage loan. Is there any questions? Okay. All right, so let's move into how much do you need for a down payment and closing costs? So the programs vary, and so the down payments are going to vary as well. So I'm just going to give you a range. We're going to talk a little bit more about the programs, I think, in the next slide or the slide after that. But down payments typically average between 3 to 20% of the purchase price, depending on the loan program. Closing costs can be anywhere between 3 to 5% of the financed amount. So in North Carolina, it's typically about 3% is what the closing costs will be. You know, I'm from New Jersey, and so that can be anywhere between 4-5%. So that's why I leave that range there, because we service more than just North Carolina. But typically you're looking at the 3%. So when Paris was talking about the 7%, let's say if you did FHA, that's like 3.5% down. We'll talk a little bit more about that in a minute. And then the closing costs, you need about 3% of the financed amount. So that's 6.5%, right? And then that other the other 0.5% is really those other costs that we were talking about as far as home inspections. Home inspections typically can run as low as $200, depending upon what it is that you're getting, $200 or more, and appraisals, the appraisal fee. So the appraisal is, as Paris said, what we use to determine the value of the home. And so let's just say that you're purchasing a house for $300,000, but the house appraises for $250,000. That means the house's value is only $250,000, and you'll only be able to get financed or approved for the $250,000. And so appraisals are really important. The bank wants to make sure that they are funding value of the home. And then you as the purchaser also want to make sure that you are, you know the value of the home that you are purchasing. Appraisal fees typically range anywhere between $500 and I've seen up to $700. It really, really depends on the house and the location of the house. And so we use an independent appraisal company, because we need the appraisals to be independent. And so whatever their rate is for that particular house, they'll inform us, and then we'll inform you as the buyer. Any questions there? Okay. Okay, so another thing I wanted to share with you today is about gift funds, right? So they're like, okay, 7%, I'm working on it, but I might be a little bit short. You can receive gift funds. You can receive gift funds from immediate family members, okay? Now, when I say immediate family members, I'll be a little bit more specific. Excuse me, your mother, your father, your stepmother, your stepfather, your aunt, your uncle, your brother, your stepbrother, your siblings. You can definitely receive funds from them as a gift. Cousins, not so much. So you want to kind of stay in that immediate family range. Also, what they'll be required to do is to send in a letter stating that this is a gift and that this is not a loan. They're also going to need to source where the funds came from. So they would be writing you a check, and you would be depositing that check into your account. And then we would need to see that that check came out of their account. I know that that may seem like a lot as far as sourcing the money, but it's really, really important because we want to make sure, not that you would be doing this, but that there's no terrorism happening, gambling funds we can't use. So there are some types of monies that we can't use in mortgage transactions, okay, by law. So that's how come we have to source the funds. And then there is seller's concessions. So seller's concessions, typically you're able to get a seller's concession between 3 to 6% of the purchase price, depending upon the loan program. And so that's unique to the loan program. And so what a seller's concession is basically you, the purchaser, adding in the cost of the closing into your loan amount. But this is something that the seller has to agree to. And this is also something that you would have, depending upon the loan program, you would have to follow that guideline. So if this loan program only offers 3% seller's cost, then that is the maximum amount that you could get. And it also has to be under the amount of your pre-approval. Okay, so let's say your closing costs, let's just say $3,000. You've been approved for $254,000, and you do the loan for originally for $250,000, but you ask for seller's concession. Now the loan is $253,000 instead of $250,000, but it's under the $254,000 that you're approved for. I hope that that makes sense and is not too much information. So those are just some things to consider, but I also wanted Paris to chime in too, because there's certain markets where sellers concessions work, and when they're they may not work as well. And so I did want her to touch on that for a little bit before I move on.
Gotcha. Thank you for bringing that up and reminding me. So in our current market, y'all know we've talked a lot about the market. Sellers concessions absolutely do not help your offer be quite as favorable. So, if you need assistance, then you can absolutely request it. You just have to understand that it makes for a weaker offer when you're in a competitive situation. So right now, I do advise my buyers not to ask for seller concessions. The only thing that we kind of ask for from sellers might be a home warranty if there are some new systems and things like that in the home. But as far as having a seller pay for closing costs or anything like that, the way that I really ask my buyers to look at it is you're basically reducing the purchase price that you're offering to them. So if you offer them, what they're asking, but then you ask for $2,000 in closing costs for them to cover, then you're actually offering them $2,000 less. I hope that makes sense. So really you have to think about it. The sellers are going to view it as a reduction to what you're offering them. So if you don't need it, then don't necessarily ask for it in this current market. When it's a buyer's market, you can get them to pay off your closing costs. But when the ball is in the seller's court, you really don't have a leg to stand on with concessions.
Thank you, Paris. Okay, and so then there's also your 401k or investment accounts where you can borrow, well, most of them you can borrow from them without being taxed. And then the monies that you're using to repay or whatever that repayment amount is not counted against you in your debt to income ratio. So those are other options that you want to think about. There's also, I have an acronym here, DPA. It stands for Down Payment Assistance. We do have a down payment assistance program, but I recommend that you just save the funds because no money is free. And so if you are in a loan program and they are giving you a down payment assistance, meaning they're financing that down payment cost into the loan, you're going to have a higher interest rate. You're going to have a higher interest rate because there's a higher risk, right? So remember, I was talking earlier about how we look at the risk factor. And so anytime there is a higher risk, it's going to be a higher cost. Okay. Okay, and lastly, Royalty Rewards Program and Crown Home Connections are something that is unique to my company, and I'm going to share that with you in this slide. So we do have a Royalty Rewards Program that we offer, and basically with a Royalty Rewards Program, you are charged 0 banking fees. And so that means no application fee, no processing fee, no commitment fee, and no underwriting fee. And that typically gives you about a $1,500 credit that's applied to your closing costs. Now, we waive these fees for individuals who are working in these particular industries. So law enforcement, educators, firefighters, municipal employees, medical workers, EMT, active military personnel, and veterans. Now, when I say educators, I mean working in education. So even if you are not a teacher, but you work for the school district, you can still qualify for this Royalty Rewards program. So it's an excellent program. I did want to share that as also an option. And then lastly, we have another program that is free to our borrowers called Crown Home Connections, which is a free concierge program. We talked about, being ready for the moving expenses and all of those things. It can be very challenging trying to situate everything in your new location, setting up your phone, setting up your electricity and your cable and your gas and your internet, all those things. I can speak from experience. When I moved here, we did not have a Duke Energy in New Jersey. We did not have so many things. I didn't even know that my particular cable carrier was a big dish. Like I was going to get a dish until they came to hook up my cable and they brung this big dish. And so it can just be challenging when you are moving. And so we are able to do this through one phone call, assisting you and giving you comparisons on the things that are in the area that you are relocating to. And so this is a free, absolutely free service that we offer. And I just wanted to share that as well. Now let's get to the loan programs, if there aren't any questions. Okay, so I'm just going to talk today about the traditional loan programs. At Crown Home Mortgage, we offer non-traditional programs as well as traditional, as well as commercial, but we're going to talk about traditional. And so many of you may have heard of FHA, the FHA loan, which is the Federal Housing Administration loan. This loan allows borrowers that may be a little bit more risky to lend to be able to afford housing, to be able to afford to purchase. And so the down payment is 3.5%. It goes as low as a 580 credit score, but I will say in Echo Paris in that 620 credit number. When you start, when your credit is a little bit lower than 620, it makes it a little bit more challenging. There's going to be more documentation required. There's going to be a higher interest rate. There's just going to be, it's a higher risk. And so again, remember I said the higher the risk, the higher the cost, right? And so there's going to be higher risk, but this program does allow for a higher debt to income ratio. So you're able to have a higher debt threshold and still qualify. And something about FHA is it has to be your primary residence. You have to be living in the particular property that you purchase. And so, but you're able to purchase single families, 1 to 4 and 1 to 4 family properties with this particular loan. Guys, feel free to take a screenshot of this information if you need to. So the VA loan is a veteran's loan. This particular loan is for veterans or spouses of veterans, and it allows for veterans to put 0% down. It's a 0% down loan. The credit score minimum is 620. The debt to income ratio is 41%, and it also has to be a primary residence for those purchasing. And then you can see the property types as well that you can get. You can also get a multifamily as long as you are living in it. Next, we're going to go to the conventional loan. So conventional loans require anywhere between 3 to 20% down. The 3% down is particular to where you are purchasing the property as well as the median income for that particular location. So not everybody is going to be able to just put 3% down. Typically with conventional, it's 5%, but there are times when you're able to put down 3%. The credit score for this is 620. The debt to income ratio is 43%. And you're able, it doesn't have to be your primary residence. You can be doing a second home or a vacation home or an investment property. You're not limited to having to live in the actual property with a conventional loan. And then we have USDA loans, which is USDA stands for U.S. Department of Agriculture loan. tongue twister. And that is a 0% down as well. Now, this loan is based upon the location of the property. There are certain properties that are considered a USDA area. And when your realtor is searching, is helping you look for properties, they're going to want to send the address of the property that you're interested in to the lender to just make sure it qualifies for a USDA loan. The DTI for that is 43%, and that also has to be an owner-occupied property. Any questions there before I move on to a reno loan, a renovation loan? Check in the chat. Been good? Okay. So a renovation loan is a renovation. You can get a renovation loan as an FHA loan or a conventional loan. The only difference is that you are now incorporating the cost of the rehab of the property into the loan. And so you're only going to have that one monthly payment as you would have on the other loans. But this loan is also including any renovations to a property that you may want to make. That can be anywhere from 3 to 20% down. The minimum credit score is 580 again, because it can be an FHA renovation loan. But again, you don't really want to go, this is just for educational purposes. It's very challenging and just a lot more restrictive if your credit is at a 580. And so I always kind of recommend that if you can bring that credit score up, then that's what you want to do to make the process a little bit easier. And so when you see the DTIs, it also has to do with the fact that it depends on what type of renovation loan you end up having. If you do one through a conventional method or an FHA, that's going to determine what the debt to income is. And so we're going to talk a little bit about how we determine how much monthly payment you can afford. But just for your information, when we talk about DTI, debt to income, what that is your total monthly debt divided by your gross income, okay? Your gross monthly income. And that will give you a percentage. And that way you'll know, okay, if I take all of my monthly debt and I divide it by my gross, where is that putting me on the percentage, on the DTI percentage? And that'll give you an idea. But I still strongly recommend that you speak to a loan officer, because not all debt needs to be included. And so you want to have a conversation, with a loan officer, complete an application to find out exactly your financial picture, okay? All right, so we're going to talk a little bit more about affordability, how affordability is determined. So I like to use the acronym CIA. C for credit, I for income, and A for assets, right? These are the three things that we're really looking at. And we talked a little bit earlier about if I'm lending you hundreds of thousands of dollars, or if you're lending your friend hundreds of thousands of dollars, you're going to want to make sure that they do a couple of things, right? You're going to want to make sure, you're going to want to look at their credit. You're going to want to make sure that they repay their debts, right? That's what the credit shows us, your willingness and your ability to borrow money and to pay it back. And so that is why we pull the credit, and that's why that's something that is used to determine your affordability. We're also going to want to look at your income. This is why we request the pay stubs and the tax returns and the W-2s, so that we can assess your ability to handle the loan amount you want to borrow, right? We don't want you to be overburdened and overstretched with a mortgage that you're unable to afford, because no one wins, right? You don't win and we don't win. And so this is just a part of our due diligence to make sure that you are able to afford the mortgage that we give you. And then the assets. We want to be able to verify that you have enough funds to complete the transaction. Now back to the credit score and the credit report. The credit score shows us your willingness to repay. So that's another factor. That's how we gauge based upon credit score. That also plays a part in interest, right? In your interest rate, because it shows us the risk factor. How risky are you as a purchaser? Any questions before I move on? No? Okay, great. All right, so let's talk about affordability. So when we take your application, we're going to pull your credit, and those things are going to show us some of your debt, right? And then the debt that you share with us. We're also going to have your income. And so that's your W-2s, any type of income that you're receiving that you want to use and that we can verify that you want to use to qualify you. So this is Jessica and John. Jessica and John are looking to purchase a home, and their monthly gross income combined is $5,500. Jessica makes $3,000 a month. John makes $2,500 a month. And so together it's $5,500. Their debt, they have a car note together. They pay $400 a month for the car note. They both have student loans. One of them makes a monthly payment of $150. Another makes a monthly payment of $300. They have a credit card with Macy's. They pay $50 a month on that. A Chase credit card for $75. And so they have a total debt of $975, right? So how we would determine their affordability, meaning how much of a mortgage payment they can afford each month, would be through this formula. So we'll take their total gross income and multiply it by 43%. We're just using that number because remember we showed the different DTIs for the different programs. So depending upon what program you're in, that's what we will multiply it by. But for this scenario, we're going to use the 43% because that's the average of most loan products. So the $5,500, which is their monthly income, times the 43% is $2,365. So then we subtract that $2,365 from their total debt of $975. And then we get $1,390, which tells us that they, with all the debt that they have and the income that they're bringing in, they can afford a monthly mortgage payment of $1,390. Now, when I say a monthly mortgage payment, what is included in that mortgage payment is principal and interest, your taxes, your homeowner's insurance, and if you have any HOA fees, and if you have any mortgage insurance, right? So all of those things are going to be calculated into that monthly payment. Does that make sense for everyone? Does anybody have any questions?
I don't see any questions yet. Y'all let us know if you have questions.
I'm gonna take no questions as good. That means that
You are thorough. Okay, Sherelle says making sense. Okay.
Okay. I'm a listen. I forgot to put on my thing that I used to be an adjunct professor, and so I like sharing and teaching.
You got it. You got it down pat. There are no questions, Professor. We are good.
Okay, so we're going to move on. We're going to talk a little bit about student loans, right? So student loans are calculated into the debt to income ratio a couple of ways, right? So if you have a zero balance, meaning you're in forbearance, a lot of us are in forbearance now because of everything that happened with COVID, right? If you have a zero balance, we still have to calculate a payment into the debt to income ratio. The way that we would do that is we would take the total amount of the loans that you owe. So let's say if there's an example here, if the loans total amount is $87,000, then we will multiply that by 0.5%, which would give us a monthly payment of $435. That is the calculation we would use if you were doing an FHA loan product. We can use that sometimes on some conventional loans, but a lot of them are still using the 1%, 1% for that. And this is not something that we regulate. This is something that Fannie and Freddie Mac regulates, right? So if it was a conventional loan product and you have a zero payments, you're making zero payments on your loan, we would have to multiply it by 1%. If you are on an income-based repayment plan and there is a monthly amount that you are paying, just like Jessica and John in our previous example, I think one of them was paying $140 and another one was paying $300 a month. We can use those monthly payments. Okay, so this is something that you also want to consider when you are preparing for to apply for a mortgage loan. You definitely want to speak to a mortgage loan officer first. I don't want you saying, oh, I'm in forbearance, let me run and do like an income-based repayment plan. You want to speak to the loan officer first to make sure that it's going to benefit you. So it all really depends on what the DTI already is and just a lot of things. So you definitely want to have a conversation about that and get advised as to your best next step. VA loans are calculated a little bit differently. And if anybody wants information on that, I can definitely give that to them offline. But I just wanted to give you an idea of how this is calculated. I also want to just note that medical bills, so if you have collections for medical, those medical bills or medical debts are not counted in your DTI. So we don't count medical bills in your DTI, okay? Any questions there? Nope, okay. All right, so we're getting ready to wrap up. I know it's a lot of information. Now I'm going to talk to you a little bit about my role as a loan officer, right? And how I get paid, right? So, and how Paris gets paid. We only get paid when you close on your property, which means that we are working together as a team to make sure that you're able to close. That's our goal. So when you're having a conversation with me, I'm going to let you know all the things that you need to do. And if that means that right now you may need to work on some things and you may not be quite ready, then that's, just what you need to do. And now you have the information to help you do that. And then when you're ready, we're here to help you move forward. And so that is how we get paid, but it's also very much a team. We want to work together to get you to the finish line, to get you in your home. Also, I'm your advocate. My job is to present a beautiful financial picture of you to the underwriters. And that is why in the beginning, when I said about like sharing any debt that you have or sharing information, like I am going to be your best friend for like the next 30, maybe 45 days, just hopefully 30, but the next 30 days. And I need you to communicate everything to me pertaining to your financial picture, things that can change your financial picture, because then I can help you present the picture to the underwriter so that we can get you to the closing table. So underwriter, you guys are probably like, who is the underwriter? Well, the underwriter is actually the person who approves your loan. I don't approve your loan, right? I'm your advocate. I take the information, I find out what you qualify for, what program, I help you get into the right program, the right loan structure for what you are desiring to do and what your financial picture currently is. And then I present all of this information to the underwriter. And the underwriter, they verify the information and make sure it meets all of the guidelines for that program that they're financing, right? And so we have very strict guidelines in order for all lenders have very strict guidelines to that have to be met in order for you to get the financing on any of those loan products, right? But the one thing that I love about the company that I work for is that our underwriters, we all have the same goal. Everyone wants to get you to the closing table. And we also are able to, we have direct access to our underwriters. Whereas some other companies, the underwriters are in a whole nother space and you don't even get to talk to them. You submit the document and that's it. We have direct access to our underwriters. So we work together as a team to do to make sure that everything is compliant and that we have all the information that we need in order for you to close on your home. And then I think I already said this, we're gonna be best friends. We're best friends through this process. So I encourage you to share information, to be honest, to ask questions. It's my job and I'm here to help you to reach your home ownership goals. And then lastly, is this my last slide? This is my second to last slide. I just want to talk a little bit about the power of equity. I know Paris covered that when she was also talking about the net worth that people were able to increase in. The question here is, how else can you save $90,000 in a year? And so I don't know if you guys knew this. Oh, actually, I think Paris shared it earlier. 2/3 of the homes last year, well, not last year, 2/3 of the homes in 2020 appreciated by 30% in 2021. I moved in 2020 and I purchased a house out here in 2020. I was one of those people. Yes, I was able to save $90,000 or increase my equity by $90,000 last year from my home that I had less than 2 years. And so what does that do? That increases my net worth, but it also increases opportunity for me. So I have an 11-year-old son. I could pull the cash out of that, start a college fund if I wanted to. I can take some of that and purchase another house. There's just so much opportunity that the equity can give you to increase your wealth. And so that's why home ownership is such a powerful tool that can be utilized. And so, a lot of people say, well, I waited, I didn't do it in 2020. Like, but the best time to purchase was always yesterday, but the second best time to purchase is always now, right? Houses continue to appreciate. And so I'm applauding you guys for recognizing that and preparing yourself to be in position to be able to experience this equity growth and this generational wealth. And so I just have myself and one of my colleagues on here. Sometimes he joins me on webinars. He's not on today, but this is your team at Crown Home Mortgage here. And we're in Cary, North Carolina. But we are completely accessible. We believe in communication and again, getting you to your goal of home ownership. And so lastly, if you are interested in talking more about your particular financial picture, please feel free to schedule a 30-minute consultation with me. My email address is listed here. You can definitely take a screenshot of that, my telephone number. And if you're ready to apply and start this process, my website is there, and you can also just go on there to apply for a mortgage and also set up a consultation. So you can do that way as well. And I'd absolutely love to talk to you about your purchasing goals and discuss your particular financial picture with you. So that is it for me. Are there any questions in the chat? Oh, okay. So Tia says she doesn't have any at the moment. Sherelle says, I like to thank both of you ladies. This was very helpful. I really appreciate all of your knowledge. This has been great. Thank you so much. I'm going to unpin myself and see if Paris has anything that she wants to share. Oh, wait, I don't think I unpinned myself.
Okay, I'm putting you earlier.
Okay, great.
I can't believe how much I just learned. That is awesome. That is our goal, is to make sure that we, give you guys as much information, as much useful information as possible. So we appreciate you all for sticking with us, because there's a lot to take in. So we just appreciate y'all for hanging in there with us. And of course, if you have questions, that's what we're here for. We're here to help.
Definitely. So we're not going to keep you guys. We know it is a Wednesday night and you probably have much to do, but we appreciate you coming on, and we hope that this has been helpful to you. And like Paris said, if you have any additional questions, definitely reach out to us and check out the podcast, because we had a really great conversation. Let me put the name of the podcast. It is available on all your favorite podcast platforms. Lovely. And we'd love to hear your feedback on that as well. But thank you guys for attending tonight.
Yes, thank y'all so much. And I recorded, so you'll get a replay in your email, because it's a lot to take in. So again, if you have any questions, just let us know. Bye-bye.